everyone. This is the Jumpstart webinar. I'm here with Roddy Bailey. We're going to talk about term sheets. Roddy, we've done this a couple of times now. I think the main thought process is that as an investor, there's a ton of flexibility when you do private investing, which is great. It allows you to structure the deal and get exactly what you want from a risk and return perspective, assuming that you can find the deals that you want to find and that you know what you want and you know how to set up the security to get the right result. The document that usually is used to start that negotiation is the term sheet. So term sheets, educational session. This is Jumpstart Health Investors. We really focus on the investor perspective, but we have a pretty collaborative attitude where obviously the investors do well only if their companies do well. I think most people who signed up probably know Jumpstart Health Investors, but just a quick commercial for us. We're one of the most active health investment firms in the country. We've been doing this for 6 years, over 100 investments, lots of experience doing term sheets. I stopped counting at 250 because I couldn't deal with it anymore, but plenty of term sheet experience. Roddy, talk about Waller a little bit.
Yeah, so our little commercial, I'm Roddy Bailey, head of the private equity practice at Waller. We're a full service law firm based in Nashville, but with offices sort of throughout the Southeast. Do a good number of transaction based law and specifically have a niche in healthcare transactions, whether those are venture transactions, private equity transactions, strategic transactions. We have sort of a niche, a specialty in healthcare, but do transactions all along the spectrum between two guys that come up with the next great thing in their garage, represent those people, to representing investors like Jumpstart that invest in those two guys, to taking that company to the next level and selling it out to a big private equity fund. So we're sort of all along that life cycle.
Yeah, excellent. And so you as you kind of mentioned, sometimes you might be representing the investor, and then the next day you might represent the company. So you're sort of on both sides of this. Where I was an entrepreneur in the 90s, but it's been a long, long time. So I'll have more of the investor perspective on things.
Absolutely. And right, both at the very early stage entrepreneur guy, the like I said, the two people have come up with something and just starting out, to selling that company out to a large strategic, to sometimes, oftentimes representing that large strategic or that private equity buyer. And so that's one of the things, again, commercial plug for Waller. One of the things that drew me to Waller, I'm relatively new to Waller, but drew me to Waller and the great experience of our team. I think we are very good all along the life cycle and know the different perspectives, as you touch on later in the presentation, Vic, to find a win-win. Knowing the different perspectives of both sides allows us to be able to facilitate that a lot of times.
Yeah. Good. So well, it didn't work. Okay, so the quick agenda, we're going to go through these 4 sections. Really, what is the purpose of term sheets? What do we use them for? And then Roddy and I will try to deconstruct it, so rip it apart. Typically, they're in a certain format, which I'll show, but we're gonna rip it apart and deconstruct it and talk about the 3 different main sections that are not organized this way just to confuse people, but what are the 3 kind of major parts of a term sheet? And then talk a little bit about strategy, how you might think about using term sheets to help sort of execute your strategy, and then we'll have plenty of time for questions at the end. And so the purpose and role, I think it's important to point out that term sheets are not legally binding, except for the confidentiality and exclusivity pieces. They're really used to get agreement, to have clarity on what the two sides, what the business agreement is on both sides, what their intent is.
And when you say business agreement, Vic, what I really think about is the economics, the board, and the founder's role. That when you say business, that's what we really, if you sort of distill that down, I think most times that's what we're talking about.
Yeah, I think that's probably a good summary. It is going to lay the groundwork for you and the other attorneys to then create the in quotes real transaction, the legally binding actual legal documents that create a security and then I or other investors put money to buy. So it's like I think of it as a roadmap. And so if you as an investor want to achieve certain things, it's helpful to get I'm calling it a business agreement, like a handshake agreement with the other side that this is our intent. And that can be very loose, it can be very detailed, but then it helps the lawyers on both sides. And sometimes there'll be negotiation around the term sheet that then either empowers or limits what the attorneys can do, kind of for a morally binding way. I mean, it's not that you can't walk away from the deal, but the business people have said, this is the deal we want to do. And so if a lawyer comes up with a novel idea later, sometimes it's helpful to be able to say to the business people, well, that wasn't the deal we struck previously.
Yep, completely agree.
So you're giving your word that you're going to do this basic roadmap, and then the lawyers will create much longer and more involved legal documents, kind of tying down every loose end. But even though the term sheet is the roadmap and it's the shorter version compared to the stock purchase agreement or other agreements, it still can be overwhelming. So like this is kind of what it looks like. They all look slightly different, but you'll see they have similar sections. But I'm just showing sort of the first 2 pages of 5. And as a new investor, it can be kind of overwhelming to see all of these terms, many of which are kind of inside baseball terms that don't have much meaning except in private investing. And so that's the point of this talk.
And like you said, Vic, I think a lot of times the term sheets are basically the same, whether it's Jumpstart making an investment or a different venture fund making an investment. They typically are sort of 5 to 7 pages long. They typically all have the same type of provisions. And so that term sheet, it is rather standard for people who are practicing in this and experience with it on a everyday basis. But to that new investor, there's lots of stuff in here that I don't want to say is not important, but it has become sort of rote and routine for everybody who does these.
Yeah, I mean, I think we'll refer to market terms a lot in this, where I don't know if it's rote, but like the market has decided that this is like the way to do things, and it's going to be really hard to see a deal get done that's not that. So there are several things in here that are like that. And then there are places that are maybe gray areas, or where there's not consensus in the market, and you can push it one way or the other based on your investment goals or what the company's pushing back on.
Yep.
So the deconstructed aspect, I think there are 4 aspects of the term sheet. And we could separate that. You could deconstruct it in probably as many numbers as you wanted, but I find it helpful. And at Jumpstart, we really focus on these 4 categories to really kind of understand. And so the first one is just the framework, like how the document works. And then there's upside, downside, and control. And we'll just go through each of them. The framework is pretty straightforward, right? You have the header. And it's interesting, the framework takes up a ton of the 5 to 7 pages, is just kind of framing things. It's in every term sheet. I often just copy it over from other term sheets. Not a lot new here, but you have the header, right? The investor name, in our case, it would say Jumpstart Health Investors or one of our funds. There's the startup company. We're buying preferred equity. You might have a debt term sheet. You could have other types of term sheets and the date. And then we have this kind of placeholder clause. So, Roddy, this is a legal thing. Talk about why this is here.
So to your point earlier, I think why we have this provision at the very beginning is to outline to both parties, this is really just a set of terms. It is not binding. It is not final. Nobody's going to give you money, and you're not obligated to sell based upon just this document. But this sets up the roadmap by which we eventually will do a transaction. And so, again, except for exclusivity or confidentiality provisions, this is just laying out what we hope to accomplish in this transaction, but it's not binding. Nobody can sue anybody over the valuation or the dividend rate or the control provisions or the board provisions that are in this term sheet.
Yeah, and that's right. I do think there is a brand reliability aspect of it. So like Jumpstart, we won't sign a term sheet unless we expect to close the deal. And so, because I think that for Jumpstart, we want to, when we put a term sheet out there, it should mean that we have the intent to do it. Now, there's a lot of detail in how the roadmap turns into an actual deal we can close on. And certainly there are times when you have a broken deal or something happens, but I think there is a morally binding, or there's a brand aspect where it wouldn't be good to have multiple term sheets that don't get followed up on.
Yeah, and I just see a question popping up real quick about who usually generates the term sheet. I would say the investor 90% of the time generates that first term sheet and gives the offer to a company. Every now and then, either number one, with a company that expects to have a highly competitive raise, we would go out with our own term sheet to try to set the terms of the market, if you will, with people. So you'll see companies sometimes doing that, or you can see companies almost the exact opposite. If there hasn't been a lot of interest and we're typically, trying to drum up interest, we might offer our own term sheet just to get a conversation started with somebody. But I would say 90% of the time it's the investor who proffers the first draft of the term sheet. And an experienced investor like Jumpstart, they've got their own in-house templates. Vic just said, he does them all the time. If you're an inexperienced investor, maybe you rely on your counsel to do that and work with you to generate that first version of a term sheet that you throw across to a company.
Yeah, I think that's right. Until you know what you're doing, you should have a lawyer help you with it. After you've done enough of them, you may. Jumpstart certainly has particular things that we want in every term sheet. So then there's a question about non-dilutive shares that we'll touch on in a minute. I want to hold that for a minute. So then we go to the participants is the next section, which really is just who is expected to be in this deal. And so there's nothing that exciting about this section. It's also on the first page, and it just kind of calls out who the company is. Everyone is accredited, which is important. You can't buy these private shares that are not on a publicly regulated market unless you're accredited. The type of security, and then the amounts. Then we have the use of proceeds and closing date. Use of proceeds, some firms use a lot of detail. We basically don't use that. I mean, I found it not that useful, but traditionally it's in there. So it's just like a generic thing. And then the close date is either a particular date or like when we can get this all done.
And one thing there on the close date, just to maybe set expectations, so from the time you sign a term sheet, I would say, and Vic, I'd love to hear your thoughts, but the day you sign a term sheet, I would say typically you're closing 60 to 90 days later. Maybe you can get done in 45, but again, typically if you sign a term sheet, Vic just said, the investor likes the deal, is committed to the deal, but there's still some due diligence to get done. That takes a little bit of time. Then, as Vic just said, a little bit of legal paperwork going back. And so from the day you sign a term sheet to the day money changes hands, I would say is typically sort of 60 days. Maybe you can do it in 45. Wouldn't be surprised if it takes 90.
Yeah, so all of this is at the front end of the term sheet, and then we're going to jump to the end of it. So there's a bunch of meat in the middle that we'll touch on in a minute, but then at the end, you have this confidentiality and no shop. It's basically a bunch of words. This is binding, and both sides have to keep it confidential, and the company cannot, once they sign it, they can't use this term sheet to go try to find other deals. And so that's an area where you're legally bound to not do that. And then there's the footer and signature box. The footer, talk about the footer again, Roddy. I mean, it's just like repeating the same damn thing again. But lawyers like to kill trees and do a lot of stuff. So
lawyers love to kill trees. Originally, lawyers were engaged and charged by the word. That still continues today. So all of these old vestiges of repeating things and making sure everybody understands what is set out above and what's binding and what's non-binding, that continues here in the footer for signature. One quick thing here as well. Sometimes you've set it up where the investor and the company signs. Sometimes we will also put maybe the main founder or founders as signatories to the term sheet as well. That's probably, again, as Vic said, is probably as much a moral thing to try to get that founder, if there's been some heavy negotiation on some items, but get that founder to sign off. This is our deal now. This is what we've agreed to. It just gives a little more heft to the handshake that this term sheet is.
Yeah, particularly if the CEO of the startup company does not have the biggest equity piece. Like there's a founder who has 70% of the equity, but he's not the CEO. You may want to get a second signature there.
Yep.
Because now that's all the framework stuff. Now we're going to go into the meat of it. The first is the upside opportunity. So these sections really define if there's a big pile of money on the table at the end, the company's been very successful, everyone's excited. How is that divvied up? What's the opportunity in that upside opportunity? And so the first and the biggest is the purchase price, right? So what is the value of the company as you are putting the money in? And it's stated usually on the front page, the front and second page, but then how many participants there are. And it's one of the most important. It is the most important for the upside category, because it defines what percent of that big pile of money the investors would get. And so, Roddy, maybe talk through this, which a ton of investors have trouble understanding how they can figure out the percent that they own. And so walk through this, and I have an example on the next slide.
Yeah, you gave me the you gave me the Excel slide when I'm the lawyer supposed to be dealing with words. But it is exactly what you just said. There is a pre-money valuation that the two parties agree to.
Yeah, that's usually in the purchase price. So
that's in the purchase price.
Pre-money value is stated here.
And then there is an amount of share or amount of investment that is expected to come in under this term sheet, under the final documents of this term sheet. So if the pre-money is $7 million and we're going to invest $3 million more, then what is, Post-money is pre-money plus the investment amount, just like you've laid out. Our portion of that is our investment amount over that total pie. And so just like you've shown here, that would show that the purchasers of this security would own 30% of the company after the deal. So if you liquidated the company the next day and sold it for $10 million, that's how the economics should shake out that day.
Yeah, and so there's a question about how the pre-money is determined, and that is fully negotiated, right? So you could use a lot of math, you could use no math. It is up to the two sides of the negotiation, whether you say we're going to take how tall the entrepreneur is and how many products they have in the market and how many children they have, and add that up, and that will be the pre-money value. Or you say the market size is 200 million and we think we can get 5% of it, and so you can have a $10 million value. There's 1,000 different ways to approach that negotiation. At Jumpstart, we take two approaches. We have fixed valuations for our very early stage companies where there's not that much there. And so in our seed platforms, we always have these fixed valuations. They're on the website. That's what we do. Because I think it's pretty binary. You either have success or you don't in those early stages. And we want to really focus on which are the best companies and how can we help them, not spend time arm wrestling over valuation. And then the other way that we work with later stage companies is really kind of working with a company through this round and the next round, and exit, and being very transparent about what are we going to build together. Here's the return Jumpstart wants. And as this rolls out, that means we have to own this percentage today. But every investor does it differently. And so the pre-money is the key aspect of the upside opportunity. A lot of investors misunderstand, and a lot of companies misunderstand the percent that they're owning. You have to include the money coming in that process. Roddy, have you seen any other magical ways to do the negotiation?
It's exactly what you said. It is for some companies, especially young startup companies, where they don't have a product yet or anything. It really is pure negotiation between the investor and the entrepreneur about what the value might or should be.
Yeah. Okay, and then there's the conversion section. So talk about the conversion section, Roddy.
So again, and you touch on this on a later slide, but the shares that the investor is purchasing, typically preferred shares, how do those preferred shares convert into common shares whenever there is a liquidity event? And so most times, just to make it simple, we apply a 1-for-1 conversion. So each preferred share converts into one common share. And then whenever there's a liquidity event, all of the common shares participate pro rata. So typically it's a 1-for-1, but there's all kinds of details that could go into that. There's a question about AntiDilution that could affect that conversion ratio, but typically it's a 1-for-1 basis.
Right. So that is the upside. Then we shifting to downside. So things don't always go well. And there are certainly cases where you lose money. And if there is a small amount of money left, so let's say you put $3 million in, and at the end of the day, there's $500K left. How is that? What's the protection in the downside? How is the investor protected? Is the investor protected? There's a whole series of parts of the term sheet that deal with this. And so it's a little counterintuitive, but I see dividends as downside protection. Certainly, you get paid dividends on the upside, but they really are insignificant in an upside, early stage, high growth company. Where they become most meaningful is in downside. And so you get to sort of accrue this dividend. In this example, it's 8% per year, and they are accruing but not paid. And then they are payable whenever there's a liquidation event or redemption, whether that is a ton of money or very little money. And so it allows the investor to get some return, even if the result is not that great. The next one is liquidation preference. And so this is the way that to make sure that the investors get paid back first. So if there's a liquidation event, if there's an event where money is being sent out to any shareholders, this clause gives priority to the preferred holders. And we have it written as a participating preferred. Roddy, talk through in the next slide kind of the two types of liquidation preferences, because this is pretty important.
Right. So we've got participating preferred, which is much more beneficial, I think, to the investor side. And then we've got convertible, you call it convertible preferred, we call it West Coast preferred, which is a security that basically gives the investor a choice of what payout they want upon a liquidation event. So a traditional preferred, a participating preferred, the investor, upon a liquidation event, the investor gets their original investment back, they get their accrued dividends back, and now they participate in our prior example, they participate for 30% of what's left over to be divvied out between all of the shareholders. West Coast preferred, you would have on that liquidation event, the preferred investor gets a choice. Do you want to get your $3 million plus your accrued dividends to date and then go home? Or do you want to convert, remember on that one-for-one basis, do you want to convert into 30% of the pro rata cap table and take your 30% of whatever the liquidation amount is? And so convertible preferred is a little more founder, common stockholder friendly, because it does not, it doesn't recognize that original investment amount plus any kind of accrued dividends.
Yeah, that's right. It's called West Coast. I think there's an attitude on the West Coast that, you know, you either were an investor in Uber or you were not an investor in Uber. Like it's pretty binary. Like you are in this deal and it's great, or you weren't in it. And in middle America, and even a little bit on the East Coast, although the East Coast is more hazy, there's fewer investors and it's more investor friendly. And so of course you want to be in a great deal that is a unicorn, but you also have this extra downside protection and it really makes a big difference in a mediocre outcome, right? So let's say the company grows from 10 million post in our example, and then 5 years later it sells for 11. That is pretty mediocre outcome. In participating preferred, you would sort of grab a lot of that value. In convertible, you'd have to choose. You probably would choose to take your investment back. But a lot of investors feel like I need to be paid kind of a appropriate rate for the use of my money. And then I also want to participate in the upside. And it really depends on your negotiating posture or your attitude to you never want to miss a deal, and let's be super friendly. You'd do a West Coast convertible. If you want to make sure your downside's protected more, you'd be doing participating.
Yep.
And then anti-dilution. So anti-dilution is when there's another round raised, at times the company has had troubles and it might be at a lower price. And so this gives you protection in that scenario. In the template, we have a weighted average anti-dilution. I think that's probably 90, maybe 100% of the time. There used to be another type, so it has to be quoted weighted average. What that means is say it's down we did $10 a share, the next round is $5 a share. That is very important if a ton of money comes in. Not that important if it's someone's putting $100 in. And so the price per share is weighted by the amount of cash behind it. And if it's a ton of money, then you get a lot of dilution protection. It's not much money, the pain's not that bad, and you don't really get much protection. Is that a fair summary?
I think that's exactly right. I would say that this can get extremely complex. You just sized it very well, but this can be extremely complex. It takes 3 pages in the documents to do, and most times, whenever it actually comes up, most times, 60% of the time, it gets waived anyway. So it's a lot of words for little effect sometimes. But this can be very complex. But I think exactly what you said. It is typical to have it. It's standard to have it. Weighted average is what we see most of the time. And if anyone wanted to get more into this, I think it's the subject of another hour-long session.
Yeah, I mean, this and registration rights are the most waste of time in the term sheet, I think.
Yes.
Because neither one actually matters. And the reason it gets waived is the new investor comes in and says, Jumpstart, we understand you have these rights and we respect that. But if you want us to put money in, you're going to waive them. Choose.
Right.
And typically, I mean, you're not in this discussion unless it has gone fairly poorly and you have a down round. And so usually there's a negotiation there. It's probably better to have it in place, but you have to figure out how to get the money in.
Yep.
Now, there was a question earlier, Roddy, about investors getting non-dilutive shares as part of their early round. Non-dilutive is very similar to a full ratchet AntiDilution. And I don't think it's that common, but someone asked about it. So there are some academic centers that are really proud of their intellectual property and try to get non-dilutive shares. That's the only place I've seen it in the last 10 years. Have you seen non-dilutive shares?
Yeah, I think that's right. Academic centers on attached to some license agreement or something like that. You'll also see it every now and then with someone coming in as sort of like an advisor to a founder at a very early stage, and a smaller number. So I'm coming in I'm going to be your sidekick, and I want 1%. I want 2%. Something small. You don't see non-dilutable shares at a 10% stake. I don't think I've ever seen that. But having an advisor, a very trusted, a very noteworthy advisor, being able to hold non-dilutive shares, small amount, 1%, for 1 round or 2 rounds, we see that from time to time.
Yeah. Yeah, and I think in general, if it's limited to the next round, I might be okay with it, but I don't really like it. I think, and the question was sort of phrased this way, could it be harmful for future rounds? Yes, it's not. I don't think it is very often that helpful. Even with an advisor at a small percentage, if they are really valuable in the next year or 2 years later, we can always give them some new shares. I'd rather do it that way than guarantee them no dilution, and then they maybe don't work as hard or they don't care about it. So.
Yep.
And then there's another question, like, do we have a formula for our 2 standard valuations for Jumpstart Foundry, our seed fund? So we always invest $150K, and it's always at 2 million or 4 million, and there's no science behind it. I just got tired of negotiating with very passionate founders that love what they do. And almost by definition, I'm negotiating with them because I love what they do. They're doing something great. And yet it's so early that there's not much to value. And so we have 2 just kind of lines in the sand, 2 million, 4 million. Not that they're right. They're certainly not right. They just are symbolic about what the company has built. Sometimes we overpay, sometimes we underpay. And we've found that it's better to speed to market. Let's get the deal done. Let's get working to help you than worry about whether it's 1.5 or 2.25 or 2 or 1.8. We just kill a ton of brain cycles iterating around on it. Okay, so then we have DNO Insurance. This is a really important clause to have in there because it's no company wants to get it. And if they sign in the term sheet, they will be forced to get it. And they should have it. They should have it for themselves. They should have it for directors. It just should be part of what they do. Doesn't cost a lot of money, but it does cost, $3,000 to $10,000 based on what your business is.
Yeah, I would say my note was 10 to 15. Maybe you found some cheaper policies.
I buy in bulk. I have 100 companies and I buy in bulk.
Yeah. But $10,000, I think that's exactly right on an annual basis. Yep.
Yeah. And so as an investor, if you're going to be on the board, I think you must have this.
Insist upon it.
Yeah. Whoops. Okay, let's see.
You did turn it off at my
turn it off, at the expense reimbursement. I just happened to slip and turn it off. So I think it's important I have this in downside protection. The lawyers and other due diligence costs should be borne by the company, in my opinion. Of course, I'm an investor, but it also should be capped. And we can debate the level of the cap, but it's usually tied to the size of the deal. So if you're doing a $300 million deal, you could probably have the cap be higher than 25K. If you're doing this example, this term sheet's a $3 million deal, I think 25K is reasonable. We might go over it sometimes. We might be under it sometimes. The way this works is if I go over it, I still have to pay the vendors, but the company is protected. They only have to reimburse that amount.
And the important thing here is this reimbursement is only there if you close. So to Vic's point earlier, not every single term sheet that you ever write will always close. And so there are, you refer to them, dead deal costs. There is the potential that you would have a dead deal cost. You should not, with this provision, you should not get it in your head that, well, if the deal dies, the company's going to reimburse me. That's not what this provides. This only provides for reimbursement if the deal closes.
Yeah, and it's very unlikely. I don't know if I've ever seen it provided that they would reimburse if the deal didn't close. Okay, then we have the control provisions. So these are the agreements of how the company is going to be run, how decisions will be made, and how the investor's money is handled. And so they're important aspects of it. So the closing conditions, these are the conditions that must be met before we close the deal. So this is what is going on in that 60 to 90 days Roddy was talking about. And you should very carefully, as an investor, should think about what do you need to have done. And I think transparency is really valuable. So we put a lot of things in the closing conditions just to be very transparent and clear with the company. These are the things that we still need to do. And you always have that number 5 in there. Roddy, I'll ask you to talk about that. But what we're going to have calls out, like in this example, we want to talk to 4 clients. And we would normally have them actually named because there may be 4 that we want to talk to. And so it's going to, or we can talk about like the questions we're going to ask the clients. And so these are the things that I think end up getting negotiated, and it's healthy. I'd rather fight through this and not sign the term sheet for another week and make sure everyone's clear about what we're going to do. But Roddy, talk about the MAC clause.
Yeah, so a couple of them. Number one, you might ask, well, what is due diligence investigation, legal? What is that? So typically we might see, especially for a company that Jumpstart is looking at, we might see intellectual property type of diligence. Do they really own what they say they own? Can it be patented? Has somebody else in the world already patented that? So there's some intellectual property investigation. And then the other one, again, for Jumpstart and Nashville, would be regulatory, or, whether there's any kind of healthcare.
Really any healthcare always ends up regulatory.
Absolutely. So we may need to get over some kind of regulatory hurdle in order to know that you can put $3 million into this company, and this company can then conduct the business the way that it says it wants to conduct the business. May need to check that on some regulatory issues. Number 5, material adverse change. This one's actually easy now with COVID. Just points out a real life example of things that could happen between signing the term sheet and actually executing documents. For example, if you had a company that had a large physical retail part of their business, COVID happens, all of a sudden people don't go to the stores, and the company just does not progress like everybody thought it was going to progress, even during this short 60-day period. So that would be a material adverse change that could happen. Similar, like the intellectual property example that I just said, maybe between signing this term sheet and closing the transaction, the company gets a letter from a competitor that says, you're violating our intellectual property. And so the company has to go back and rewrite its code, or has to figure out a new way to operate its business. And the result of that doesn't make the business opportunity nearly as compelling as what we all started this process with. That would be another example of sort of what we call a MAC, material adverse change, a MAC provision that would then give the investor, again, as Vic said, no legal obligation has ever been created, but really gives you moral standing to say, listen, things changed. We're not going to go forward right now.
Yeah. And I want to keep pushing through because we're running out of time, but the redemption clause is the investor's ability to force the company to get them out. So, Roddy, talk about the different ways it can be structured. I mean, this one is a pretty friendly one, but you could have lots of different ways to redeem it. This is 7 years and a mutually kind of agreeable process.
7 years and mutual agreeable. We see somewhere between 5 and 8 years is usually that time period. It could be a mutually agreeable. The investor could have the right to demand that the company go for sale if the company doesn't have the cash to be able to redeem the preferred shares at that point in time. My notes on this is merely a stick. It never happens. I've never been in a situation where a company has actually redeemed preferred stock.
I haven't either, but I have used the threat. I've used pointed to the stick several times. Like, I got this stick in 2 years.
That's right. And what it usually does is then force management, the board, to then embark upon a liquidation strategy to go put the company up for sale or go find a buyer or something, versus actually carrying out the redemption process.
Yeah. But I think it's important to talk through, because a lot of newer investors will get stuck where they don't have this, and they don't have a stick, and the entrepreneur, the CEO, sometimes can get comfortable. I'm taking a salary, and this business is working well for me and for my team, but they're not really ever going to sell. And you're kind of like dead money sitting there without a stick to say, like, I'm going to do this. So it's an important
zombie companies.
To have.
Right. And it creates a zombie company.
Yeah. I'm going to push through this. The voting rights just says, like, even before you've converted, you get to vote as if you had converted. That's a pretty standard clause. the covenants. So talk through covenants in a minute or less, Roddy. I mean, these are the things that the company is disclosing in the process.
And more importantly, these are things that continue after signing the term sheet, after signing the actual investment documents. These lay out sort of the groundwork of what the company cannot do without investor consent. And investor consent would be usually a majority, sometimes 2/3 of the holders of that $3 million of preferred stock have to agree, have to give consent if the company wants to undergo any of these types of provisions. So any of you all that are familiar with sort of loan agreements, this is similar type of provision in that the company can go operate its business, it can go do ordinary course kind of stuff, but these things we've deemed as very material, and you got to have investor consent to complete these.
Yeah, so that's why it's in the control section. Then in our term sheet, we carve out separately, like a different line, this additional covenant, because it's so important, and I want to make sure people, the management teams, are clear on it, which is they are hitting all the requirements for a qualified small business stock. And the reason that's important to me is it gives me tax-free status, or I think the proper way to say it is 100% reduction of the tax consequences if we hold it for 5 years, assuming that the company qualified. And the easiest way for me to ensure that is to force them in the documents to indicate whether they do or not. Information rights, right of refusal. This is sort of, again, control, like how we would make sure we have appropriate information. And then we have the right to purchase shares that are offered by the company or by other shareholders is the ROFR. Anything you want to add on that, Roddy?
Nope.
Registration rights, I mentioned earlier, this is the most made up thing. I mean, it sets up how the company will register the securities when it goes public, and the underwriter completely changes everything in this section. So if you're lucky enough to be an investor in a company that goes public, the investment bank that's doing it is going to renegotiate this entire section. So I would not spend a lot of time if they're always in there, and I think they're always not that valuable.
Agreed.
So the restrictive covenants, talk about this, Roddy. This is an important control aspect.
Yeah, so typically, this CEO, this management team, this founder team that is running the company, when the investors come in and put $3 million in, we want to make sure that founder team is going to stay engaged and is going to carry out that business plan that we've invested that $3 million in. So lots of times we will put in some kind of non-disclosure agreement. There are other provisions like a non-compete that sometimes get negotiated and talked about. There's other aspects that I would call a revesting. So the founder owns 40% of the shares of the company. And of course, the founder owns those outright, but an investor might say, well, that's fine, but you're going to revest in those shares, a third over the next 3 years to make sure that you can't just leave the day after closing, take all your shares with you and be able to go compete with us or something else. There's a quick question about how enforceable are these non-competes. I think that's pretty enforceable. There's a lot of consideration, $3 million being paid to the company. The founder is benefiting by that, certainly indirectly by continuing to have a job and giving potential value to those shares that founder continues to hold. So I think that non-compete is rather enforceable in those situations. Non-compete revesting, not as much. So that's probably, I wouldn't say that's a majority of deals, but certainly these restrictive covenants around NDA is 99% of all deals have that.
Yeah. And then the board. So this is your chance to really define the board of directors in negotiation with the company management. And this is one of the most important aspects of the control in the term sheet, that how is the board going to be constituted? What are the voting rights of each of the seats? So like in this example, 2 directors designated by the preferred A stock, 2 by the common, and then 1 by the preferred and common voting together. That's fairly balanced. I mean, management teams would debate that with me, but this lays out, and the board, and of course, hires and fires the CEO and approves the budget, and has a lot of control provisions in a C corporation. So that's the deconstruction of the term sheet. As far as negotiating strategy, the Jumpstart opinion is that you can pick 2, right? So you have upside, you have downside, you have control. Rank order what you think is most important given your goals and your priorities. Often the entrepreneurs or the management team will have different priorities, or they may not understand it as well. And so this allows you to have a true kind of win-win. Like if you are focused on a couple of them and the management is focused on others, everyone can be really happy and honestly feel like it's win-win, because you rank things differently. So our strategy has been, for the last 6 years, and even before I started Jumpstart, we want upside. Upside is number 1. When things work, we want to be positioned to grab as much of the upside opportunity as possible. And then we want reasonable control provisions. So we feel pretty strongly about the control aspects of the term sheet. I'm not opposed to getting downside. I mean, I'll take downside that is offered, but I will give up downside to make sure that our priorities are negotiated. And that can be helpful. At least and you can be intentional about what you're negotiating for. And then if you find a management team that is the opposite, they're worried about not giving up downside and they're reasonable about control, everyone could be really happy. Roddy, do you have thoughts about negotiation strategy?
Yeah, and I think I was going to take the other side. The most founders, entrepreneurs probably have the same issues that Jumpstart does, in that they are probably most worried about valuation. That equates to the upside opportunity. And they're probably secondly worried about control. It scares a lot of entrepreneurs about a board and having additional board members. And so they usually fight about valuation, usually fight about board control, and usually give very little credence to downside protection.
Right. Yeah, so there are times when we have the same priorities, and then we have to just sort of negotiate through it. And so with that, we have time for a couple questions. We've been answering them along the way, but does anyone have questions that they want to throw out in the last few minutes here? I don't think the microphones are on, so you have to type them in. Okay, I think we may have just answered the questions along the way, Roddy, but this has been great. Thanks for taking the time. It's a topic that is, I don't know, people assume that everyone knows it, but I've found that a lot of investors spend time and money and invest a lot of capital without knowing all the details like this. So I appreciate you taking the time to walk through it.
Absolutely. Happy to do it, and happy to follow up with anybody afterwards if any kind of specific detailed questions. Yeah,
and so the website for Jumpstart is Jumpstart Health Investors. What's the Waller website?
wallerlaw.com.
Okay, and Roddy Bailey is the lead of the private equity group and the best person to talk to if you want to spend a ton of money with Waller Law.
Which everyone should want to do.
Everyone should. Yes. Okay, well, thanks everyone for joining. Thanks, Roddy, I appreciate it. We will clean this up a little bit and package it and then send out the the video to everyone that RSVP'd. And then I also have a template term sheet in Microsoft Word that if people want, shoot me an email or text in, and I can provide that to you too, which, I find it easier to take the template and then customize it than to have just a blank sheet of paper and trying to do it from scratch. So. Okay, thanks everyone. That's a wrap.